Today, we are particularly delighted because of the topicality of the issue, contemporary issue that is being presented today, which is on the impact of the Russian-Ukrainian war on global financial markets. And this is an interesting paper by Dr. Vasileios Pappas, who is present here jointly with the Athena Petropoulou of the Center for Global Finance. Let me take the pleasure of introducing Dr. Vasileios Papa, who is indeed a brilliant scholar, currently serving as a senior lecturer in finance at Kent Business School, the University of Kent. He holds a BSc in economics from the University of Pillars, the MSc in money banking and finance, and a PhD in economics, both from Lancaster University. And he is very prolific. His core research interests lie in the areas of empirical banking, with a focus on bank efficiency, competition, liquidity creation, financial stability, and also looking at various types of banks, from conventional banks, community banks, and Islamic banks. So I find that he shares research interests with a number of us here in the Center for Global Finance, and also present at this research seminar today. His other research interests include, many areas in financial economics and in financial econometrics, focusing on issues like volatility modeling and forecasting, issues of financial contagion and market microstructure, and in these areas in which he has published in top journals in the economics and finance professions. But he also not only an excellent academic, he's also an advisor to policymakers, and he has acted as an advisor to the Hellenic Financial Stability Fund, HFSF, on the forecasting of non-performing loans of Greek banks. So he's very versatile, experienced, and highly prolific as a researcher, and also, of course, as a policy advisor. His co-author is Athena Petropoulou, who indeed is prolific. She was my co-author and co-presenter for the paper we received last week, and she's still running, also co-author in this particular paper. I find that this seminar is absolutely contemporary in terms of bringing to the fore one of the key issues which appears in the headlines every day, the Russian-Ukrainian war, and the way global financial markets in London, New York, and elsewhere are up and down, as you can see the volatility of the values of the pound, the dollar, and also other financial assets are being traded on these markets. But also the paper is interesting, the way they weave in some of the issues of the multiple shocks, because the shocks are not only due to the war, but also the shocks that are rising from, COVID-19 pandemic. And of course, remember that it's only a couple of years ago, not so far away, when we have the global financial crisis. So this paper does it all. It's in that context that we very much welcome Vasileios. Also, we very much look forward to your own views, whether you're a researcher, a policymaker, civil society, but you are participating in this seminar. Please take a moment and share your views with us in reaction to the presentation. So with those words, it's my great pleasure to ask Vasileios to please start presenting the paper. Thank you.
Thank you, Victor, and thank you to all the CGF Seminar series Thank you for the invitation to present. And I have to say, this is one of the seminars that I have been, it's an honor to me to present here because I've been keeping track of your seminar series during the COVID pandemic, and it has been an excellent company indeed, and particularly with the friendly atmosphere that you have. So allow me to start with a brief introduction on the paper that we have today. As Victor has said, it's a very contemporary issue, and it's all over the news about the war that is going on between Russia and Ukraine, whether it's going to continue, how it's going to affect our everyday lives, how it's going to affect our budget, and how it's going to affect policy making decisions. Um, so I think it was a few months ago, just I was sitting on this table and had some discussions with my co-authors that you can see here, among which Athena Petropoulou, Gulnur Muradoglu, Marwan Izzeddin, and Siza from various universities. Athena is with us here today. And I was sitting here and thinking, okay, there is an invasion going on, and what can we take from this? What can we see about the impact on financial markets? How would it compare, let's say, to other events that we have experienced as humankind in the past 10 or 15 years or so? And how different would that be? Um, So the presentation roadmap for today, it would start with a basic introduction, then move on to some research questions, the motivation to study how the war has impacted financial markets, and the contributions of our paper. We are going to have a brief overview of geopolitical events and volatility across time. And then we're going to introduce the data and methodology that we would be using, together with the synchronization, duration, and intensity measures we are going to use to compare and contrast the crisis events across time and also across various asset classes. We're going to look at some key examples and then move on to results, roadmasters, and then open the floor to discussion and conclusions. However, if you feel that there is a question as we go along, please feel free to interrupt. Have no issues. So I remember I was sitting on this table on February 24 and listening that the war breaks out, and at the same time, Moscow, of course, stock markets had a shock on that day. Of course, Russia, but also globally, European stock markets plummeted. Then, of course, they recovered, but the ball was rolling. And the ball is still rolling until today as the war goes on. And so far, the discussion has moved away from global stock markets and commodities and has moved on to the real economy and how economic forecasts are being adjusted, how inflation has reached double-digit numbers for the first time, I think, since the World War II. So it kind of sets the scene for what is about to follow. And we are going to be focusing on the volatility response of stock markets, global stock markets, and also a pair representative sample of commodities. So we want to look at these two categories. How did they respond to the Russian invasion and the oncoming war? We're going to examine the timeliness and the magnitude of these responses and also compare to past crisis events. Most notably, the COVID-19 pandemic, the financial shock of the COVID-19 pandemic, and of course, the 2008 global financial crisis. Our motivation, of course, this marks what we believe is the first war in Europe since the World War II. Now, of course, this might be a little bit debatable because we we also have some other smaller scale wars back in the 90s, like in the Balkan states. So there were some kind of wars for independence, or as the former Soviet Union was breaking up. But for a long period, this is the first war in Europe of a large scale, quite unpredictable. But also, there have been several warlike, as we classify, events since then. But these more or less have either taken place away from the European continent. For example, think about US invasions to Afghanistan or Iraq or these kind of things, or have been classified as terrorist attacks, like the 9/11 or the Paris bombings or the London bombings, things like that. These are massively different than a war or an invasion. And we're going to see this in the results. And that's why we argue that financial markets may not have perfect memory of a war situation, and therefore may not be perfectly able to project this event on the financial markets. It's also very important to note something that motivates our decision to look at commodities, the key status of these two countries as exporters of strategic commodities. And of course, your mind would rush to natural gas for Russia, but also wheat and nickel are very, very important commodities, as we shall see. Of course, volatility, the focus is on volatility because volatility is very important in the world of finance for analyzing the risk in the financial markets. And of course, very crucial because it enters as a calculation in the pricing of derivatives and other financial products. So volatility is very important. Yep. Okay. So we contribute. There is a fast emerging literature, as usually happens after every crisis. Think of the global financial, think of the COVID, think of the dot-com before that, or think of the European sovereign debt crisis. All of these crises in academia and in policy making have been used to ascertain the effects on various sources of the economy. So we offer an early assessment of European and global stock markets and commodities to this war event, and we compare the war response against the recent COVID-19 pandemic and the not too distant 2008 global financial crisis. And in terms of methodology, there is also a contribution here, smaller contribution, that we augment the popular heterogeneous autoregressive model, the HAR model, which is very popular in the modeling and forecasting of volatility. So we incorporate non-linearities that are very important to capture structural breaks, to capture crisis effects on any time series which the volatility belongs to. A preview of our key results, so we know what are the key findings, we know what we expect from this paper. We document a very fast reaction of stock markets and commodities to the war. So stock markets and commodities respond almost instantaneously. This tells us that invasion was not anticipated by financial markets. It was interpreted as real news. Of course, there was like a building up of forces of Russian forces along the Ukrainian border, but this tells us that a war was really not discounted, if you would like. Now, this response is much faster compared to either the global financial crisis or the COVID-19. However, besides the reaction, the timeliness of the response, we also have measures on the severity. And it's the severity of this response that has been more muted compared to the other crises. And this begs the question of why a war event is is having a more muted response by the financial markets? Is it not as equally catastrophic of one huge investment bank? Is it not as catastrophic as a pandemic? Why is this difference? We attribute this to several reasons. For example, that the expectation that the war would not drag for long. And in fact, back in February and back in March, the expectation was that any military operations would probably take 2 or 3 weeks. Then in May or June, they said that probably it's going to stop sometime now. And then there is a discussion that probably the war is going to prolong for 1 year or 2 years. And it was only 1 or 2 weeks ago that Russia announced that they are conscripting people to go actually to fight beside the any actually like any professional uh, army. And this led, of course, many Russians fleeing to Finland or to other countries. Now, the commodities, they concur with the stock market results in all but one aspect, intensity. So intensity, how pronounced was the impact of the war on commodities is the main difference between the stock market response and the commodity response. And just to be clear, the analysis that we're presenting here, the results that we're presenting here are with data typically up to mid-May, as we're going to explain later on. So up until that point in time, the commodities really gave us an early warning signal that something is going wrong. Commodities were better able to capture the intensity of the war. And of course, now this translates to high-end inflation. What does the literature say about various geopolitical events? So we can classify them as geopolitical, because some are wars, some are just political tensions, other are bombings, and so on. Obviously, wars destroy human capital, physical capital, and stock markets react in a downward way. That is kind of expected. A large part of the literature has focused on World War II events and countries involved in the World War II, and of course with the expected kind of results. So, okay, bond returns were going down, and other wars that have been studied in the literature include the war in Iraq, the Korean War, and other U.S. involvements. So the literature is typically biased on where the U.S. is involved in a war, and they would be studying either the impact on the U.S. financial markets or on oil importing countries that were affected when the war in Iraq started. This is a snapshot. So this graph shows shows 4 things. It tracks volatility across time. We are using S&P 500 data, so it's US mainly focused, due to the very long period of time. So it tracks the S&P 500 all the way from the 1920s and the Great Depression period up until the war in Ukraine, up until our data set. And it plots realized volatility and conditional volatility, 2 different measures of volatility that we are using and we are going to explain in greater detail as we go on. And it also tracks the very popular economic policy uncertainty indicator from sometime in the mid-80s that started being produced. A very well-known news-based measure of the uncertainty in the financial markets. And it also tracks the popular geopolitical risk, the historical version of the geopolitical risk index in red. And on the graph, we plot key wars, we plot terrorist bombings, we plot other important financial events like the Black Monday or the Lehman collapse or or the COVID. And what this graph tells us is that volatility and uncertainty increases as these events happen. Of course, some of the most important financial events cause the volatility to spike up, like in the Black Monday or the Lehman collapse. But typically, we see that wars have less pronounced effect than these financial disasters or the exogenous pandemic shock. Apart from a few isolated cases, like perhaps the 9/11 bombing, the Iraq War, and of course back in the 20s and the 30s and the 40s with the World War II events. Volatility. Contrasting volatility to returns. Returns are what we say they are observed. There is no ambiguity on how we calculate logarithmic returns. However, there is an ambiguity of how we proxy volatility, how we measure risk. And across the years, there have been several measures that have been proposed to quantify risk. And they are all under this umbrella term of volatility. Early proxies like squared returns were used. These have been very noisy and kind of dropped subsequently, and they have been superseded by conditional variance estimators, like think of Gart's family of models here, with all the subsequent developments in that family, and of course stochastic volatility, which are a little bit more complex. Now, this is fine up until, let's say, mid to late 90s, and in which point there is a paradigm shift because high frequency data become available. And by high frequency data in financial markets, we typically mean either minute by minute data or second data, at 1 second granularity, or at the finest of intervals at the tick level. That means as transactions are recorded. So this is what is classified as high frequency data. Now, why these are important? Because they allow us to construct realized measures of volatility. And within the realized measures of volatility, perhaps the most well known is the realized variance, the RV. And the realized variance has been shown to dominate Gart's type and stochastic volatility models. And just to compare and contrast these, Gart's type and stochastic volatility require a model, and there are parametric ways of getting volatility. That means you have a model, you are looking for coefficients, you have some assumptions on the stochastic error term, and so on. Realized measures are not estimated, they are computed, if you would like. So they are much more flexible to use. However, because they do not have a model per se, it's just like a calculation, they require a model to have any inferences on modeling and forecasting. Because volatility volatility is like a long memory process, so it has a very high autocorrelation degree. The typical model that was used up until 2009, roughly, it was the ARFIMA types of models. The ARFIMA type of model had some restrictions because it was only maximum likelihood estimation that could produce these estimates, and it was very, very cumbersome to expand as a model. So in 2009, the heterogeneous autoregressive model appears that allows for easy modeling and forecasting of all realized measures, or actually any measure that has very strong persistence or very, very strong autocorrelation properties. In terms of the data we use, so in this exercise, we go by the 3-month window either way of the event using daily data. And we consider 3 events: the war with the invasion date of 24th of February, COVID-19, where we used the Italy lockdown announcement on the 9th of March. And this is actually consistent with some other studies. I understand there might be some disagreement here, but actually the 9th of March is roughly a week before the collapse of the stock markets following the COVID-19 financial crisis. And in the 2008 global financial crisis, the Lehman Brothers collapse is considered as the benchmark or the top point of the global financial crisis on the 15th of September 2008. Our data for the stock markets, we resort to realized volatility, which is sourced from the Oxford Mann Institute. So they do the calculations, and these data are provided, a very good database if you want to use. The data are provided for free, and the realized variance is calculated in the normal way as the sum of squared intraday returns. And the intraday period that is used is the benchmark in this literature of the 300 seconds or the 5 minutes. If you go anywhere on an even higher frequency, then you start to get a lot of microstructure noise. Anything lower than that, then you don't really get the benefits of high frequency data. So the 5 minute base is considered like a benchmark here. The restriction here is that the RV is only available for a few countries, roughly 25, 26 countries, which we list here, and we include all of them, and we separate them in groups. So the groups can be overlapping. So the G7 group, the G7 group has some countries in the European continent, and also there is the rest of the world. For commodities, our restriction here is that there is no such database that constructs realized measures for the commodities, and actually getting tick level data for commodities for over these periods of time, it can be quite expensive from the databases that are using it. So we resort to conditional volatility measures that are obtained through price data, return and price data from Bloomberg. And we do so by fitting the benchmark GARCH11 model on each of these commodities. So it's a quite comprehensive sample of commodities, and we arrange this into 4 commodity groups: the energy, the precious metals, the agriculture, and the base metals. For the methodology, as we said, volatility is highly persistent, and the HAR model is one of the preferred specifications. It is dubbed as a short-term memory approximation to long-term memory. And this is because volatility would sit on both sides. So the way the model is motivated is because different agents in the stock market, in the financial markets overall, would have different priorities. So in this specification, you would have agents that have like a 1 day horizon, which stands as D here. Others may have like a 1 week horizon, and others may have like a 1 month horizon. And the specification for the daily component is typically an AR1 process, so one lag of the volatility. But for the weekly and the monthly, is typically constructed as an average of the trading week and the trading month, respectively. The model can be estimated very easily using least squares technique and robust standard errors, and of course can be expanded to include macroeconomic shocks, macroeconomic variables, or to include other, perhaps other stocks or in general the stock market index and so on. Things that under an ARFIMA specification would be notoriously difficult to achieve. What we do is we introduce nonlinearities in this setup. And by introducing nonlinearities, we typically want the coefficients to change across a period that is a calm regime, and also there is a crisis regime. And the way to do that, we incorporate a Markov switching structure in that model. Now, the Markov switching model on its own is a discrete type of model that allows for a structural break. And it also allows us to endogenously determine the shift. So it does not require any assumption from our side on what is the crisis transition date or what is the breakpoint date. It actually lets the data speak for themselves. Now, in notation, there is a latent state variable, and that state variable is basically determined from the past state of the economy or the time series or whatever. The state variable can accommodate many states, but in practice, we opt for two states, the calm and the crisis regime. So a Markov switching implementation has also been used with GARCH models to achieve a similar result, like introducing nonlinearities and accommodate for crisis. So when we introduce the Markov switching structure in the HAR model, basically the coefficients, the level, the constant, and the first coefficient on the daily component actually can now be regime dependent. Okay, so we can have a level for the volatility in the calm period and another level of volatility for the crisis period. Okay, that's why we have them here subscripted as ST. Now we don't introduce nonlinearities for the weekly and the monthly component, basically for tractability, because we only have 3 months, and anyway, these would take longer time to adjust, and in fact they may not adjust anyway. So most of the attention is focused on these two coefficients there. We estimate, of course, the model now, since this is now, it has a Markov switching structure, it is estimated using maximum likelihood and again, robust standard errors. Then on the basis of the results, we construct synchronization, duration, and intensity measures. For the synchronization, we assess for each asset, whether it is a stock market index or a commodity, we assess the crisis transition date that is estimated from the model, from the Markov switching HAR model, to the benchmark date. And the benchmark date can only be one of three, whether the 2008 global financial, the war invasion, or the COVID-19. So positive values here would indicate a lag, that the asset has been affected with a lag following that news, or with a lead if the synchronization is negative. Duration is, the formula might look complicated, but duration really means, so once you have transited from the calm regime to the crisis regime, how much time have you spent in the crisis regime? The time you spend in the crisis regime can be in one go, or you could be changing between crisis and calm regimes as you jump up and down as the dynamics evolve. So the duration really measures the percentage of time, whether in days or in a percentage, of how much time you have spent in the crisis regime following the transition. Of course, higher values of that would indicate that you are more time in a crisis mode. Intensity now measures the relative difference of the calm regime and the crisis regime. So the Markov switching basically tells you that you are going from a calm regime to a crisis one, but it doesn't say how far apart these regimes might be. Obviously, it makes a difference to the crisis, to the magnitude of the crisis that you experience as a country or as a commodity. So the intensity really measures the average difference between the volatility in the calm regime to the average volatility in the crisis regime. The formula might look complicated, but I think the explanation is making more sense. It's really how far the volatility has spiked on average. Let's look at um, some examples. So in this graph, we have the global financial crisis on the top graph and the COVID-19 crisis on the bottom graph. And there are stock markets for roughly for the G7 countries. We don't have Italy here because Italy was not available as a country in the realized measures for the global financial crisis. As you can see, there is a spike of volatilities following the crisis, which is expected. And you can also see that the volatility spikes are quite pronounced. So there are jumps in the volatility in all of the countries. And there is also a timing difference. So in the global financial crisis, the volatilities would spike a little bit later than the COVID-19. This is what happened after the the Russian invasion. The response is much more muted. There is still a jump in the volatility, as you can see circled, but it is nowhere near compared to the global financial or the COVID-19. So there's a short-term reaction, it's a fast reaction, but it's also much more muted. The same thing would be also observed in commodities. So again, on top we have some representative set of commodities, so that we have some quality in the graph. And on the bottom, it's the COVID-19. So you can see that some commodities respond much slower than others, but they also tend to revert back to normal conditions. This is what happened after the Russian invasion. You have some commodities here, some strategic commodities, as we call them, for instance, the wheat and the nickel, where the volatility really spikes up. And this is a very fast and very pronounced response, driven particularly by the status of these countries in the production of commodities in the world. Some different examples where here we focus on the UK on the left graph and wheat on the right graph. So on the left graph, we have the UK volatility response around the global financial crisis with the orange line, the COVID-19 with the blue line, and the war event with the gray line. And you can see how more pronounced the responses are during the global financial and the COVID-19. Whereas the impact of the war, even though there is a jump initially, then it trails off. It's like the stock markets here are saying, okay, it's not important. We don't really care about it. At least we don't care about it as much as we did with the global financial and the COVID. But look what happens in the wheat. In the wheat situation, global financial and COVID, the response is basically flat. But during the war, it really shoots through the roof and stays that for quite some time. Now, is this important? Well, it should be, because wheat is a very, very important commodity. Some results now for the stock market. So the table looks a little bit messy. But what is important is the medians are down at the bottom by country group, the G7, the Europe, and the rest of the world. So we are comparing these, and the main takeaway from this is that crisis synchronization figures suggest an instantaneous reaction to this event. You can see the numbers, for example, for Europe, 4, in COVID-19 down to 1, and during the war is at 0. So that shows us that there is an instantaneous reaction to the event. So war, yes, it is interpreted as real news by investors. Okay. And also the response to the war is much faster compared to the global financial and the COVID-19. How about the duration and the intensity? Well, duration is much more is short-lived for Europe, unlike the global financial and COVID-19. And the intensity, though, is lower for the G7 and the rest of the world, but it is higher for Europe. So yes, in Europe, the intensity figure shows that there is something going on. There is a jump in the volatility. There is a jump in risk, a jump in the uncertainty, if you would like. But because the duration is so short, it's short-lived. So there is an expectation now that this would not go on. So we are thinking, has there been any misinterpretation by investors? Why this short duration? Is it an expectation that the war would not be prolonged? Well, this coincides with the rationale in the press back then. It does not coincide with what's happening now. Or would it be that there is a short memory from the financial markets and they do not have a similar experience to draw upon? The most recent war in Europe, it's several years back. And if we try to draw conclusions from similar war-like events, just like the ones we have plotted on the graph, they are markedly different. They might be outside of Europe. There might be for completely other reasons, or there might be terrorist attacks. So there are differences here to this event. Commodities, again, some similarities. They also respond very, very fast, much faster than either the GFC or the COVID-19. And this is basically driven from the precious metals and the base materials. The duration on average, that means across all the commodities now, is lower. So again, a similar story to the stock markets. And the intensity values are also similar. But the average here masks some important differences. For instance, if we focus on agricultural commodities, they do respond fast with a 2-day lag compared to 17 days in the COVID-19. But they also show approximately 2 times higher duration compared to the COVID crisis. This is much different than what happens in the stock markets. Or, for example, for the wheat, the intensity value of 48 is one of the most severely affected up here, for instance. Wheat and nickel, besides the oil and gas are the usual culprits, are amongst the most affected commodities. Now, because of the importance, the strategic importance, particularly of wheat, this leads us to say and conclude that there is a strong ongoing pressure on commodities. And this seems to be like a cause for concern, at least as far as inflationary pressure is concerned. Because on one hand, you have gas prices being higher, and also you have a very important agricultural commodity that enters into the basket of goods of the family. And this is important for policymakers, but it's also important for economic policy making, whether it affects inflation in multiple ways. Think of where wheat enters, pasta, bread, everything. In terms of robustness, we do a robustness check with So the Markov switching is a discrete model, and we also employ a smooth transition. So you can be moving between regimes from a calm regime to a crisis regime, either in a jump way, in a discrete way, or you could be slowly transiting to the crisis regime. The smooth transition model actually assumes that there is like an analog-like process from going from the calm regime to the crisis regime. And the smooth transition, the STHAR model, estimates two key parameters. The threshold, which again is estimated through the data, so we maintain this data speak for themselves property of the Markov switching model, but we also have a slope coefficient that is also estimated through the data. The formula here would look a little bit more complex than the previous one because unlike the discrete transition where you can be in only one state at any given time, here you can be in a mix of states. So it's like a weighted average of the first part of the model, the one you see with the beta coefficients, and the other bit on the right-hand side with the delta coefficient. So it's always like a weighted average, these smooth transition models. So of interest here are the threshold coefficients that gauge the synchronicity of the transition and therefore are mapped against our synchronization measure. Again, high values would indicate a lag, so you are affected later. The slope coefficient is measuring the transition speed between the regimes. Now, the transition speed is not exactly the same as duration and intensity, but a high value of the slope coefficient would suggest an abrupt shift, so a more pronounced shock in the economy. Obviously, the higher the value of the slope coefficient, then really the argument in favor of a smooth transition model really collapses, and we should be focusing on a more like discrete type of model. A very popular smooth transition models are the E stars or the L stars and all of these. So these are some of the results. So let us focus on the slope coefficient on the mid column and the threshold coefficient on the right hand side columns. So our robustness complements our main story because we observe a lower threshold during the war event for the stock markets and commodities. So this confirms that these two asset classes have been affected sooner than compared to the global financial crisis and the COVID-19. The slope coefficient is highest for the G7 stock markets during the war. That indicates a more abrupt regime change compared to the COVID-19 and the GFC. So the G7 markets appear more panicked with this model. The European stock markets, on the other hand, respond in a smoother fashion. So it seems that there is not much attention to this event as opposed to the COVID. And the difference here is massive. So this leads us to further corroborate actually our finding that investors may be falsely assessing the duration and the severity of this event. So coming to the conclusions, in this paper we analyze the impact of the Russian-Ukrainian war on global stock markets and commodities volatilities. Last but not least, we compare to the global financial crisis and the COVID-19, and we implement a Markov-switching HAR model that allows us to draw estimates of synchronization, duration, and intensity for each crisis and for each commodity, which we use for our conclusions. We do find an instantaneous reaction to the war. This is true for both the stock markets and the commodities. However, the severity of this response has been muted compared to any of the other two crises. And we attribute this to the expectation that the war would not be prolonged. The extra insights we get from the commodities is that the commodities could have significant implications on the financial markets and the real economy through contagion effects. For that, it's key that some of these are of strategic importance and may lead to lower economic growth, rising inflation, and also political tension. For instance, recently, the annual GDP growth for 2023 has been revised downwards, significantly below the pre-war forecasts for worldwide, for the US, and also for the euro area. Now, inflationary pressure from these commodities is also compounded due to the COVID-19 policy measures that most of the countries had already taken. So inflation is not only from the war response, but is also compounded due to the massive money supply extension that was provided in response to COVID-19. And you can see that in the very recent pound depreciation, where the government wanted to simply alleviate some of the burden of the households, but then it was faced with tension from the financial markets, and then they had to cut back on some of these measures. On the energy front, before the war, the focus had been on the green economy, on the transition away from fossil fuels, and that was energy efficiency and all of these things. And that was a priority for policymakers and to a certain extent, perhaps from households. However, following the war, this would only come at an increasing cost, and perhaps policymakers now decide to put energy stability and affordability higher up in their agendas. Because obviously, it's a very different environment when you are purchasing gas or you are purchasing electricity from abroad, and that keeps spiraling up in terms of costs. On the food front, rising prices and shortages may also shake the coherence of the society. And when the coherence of the society is threatened, that may link to the rise of extremism. Think of the Italian election results recently, for instance. Or think about how any policymaker or any government would react to a rising proportion of households not being able to make ends meet because of the rising prices. Ultimately, longer-term consequences will be dependent on any policy responses and priorities set today. And last but not least, when we discussed about the political tension, we have to remember that at least within the EU, where there is heterogeneity, this leaves even more room to political tension, where a certain number of countries or states might be pursuant of different goals than other ones. Think of some time ago, I think it was in May, about a discussion about a voluntary or compulsory reduction in natural gas consumption. I think it was by 15%. So some countries wanted that to be voluntary, others wanted it to be compulsory. And only today I was reading that the European Union is now considering like a plafond on the prices of natural gas, something that last week was not willing to discuss. So thank you very much for your attention. I would open the floor, I guess, to any questions and discussions around this topic. Thank you very much.
Thank you indeed, Vasileios. Very, very interesting presentation. Very clearly presented, even making the complex econometric work seem very clear and easy. And of course, the pertinent issues are important. The way or you could combine the the war and the COVID-19 and global financial crisis is absolutely very novel, and the results are appealing and interesting. Um, a number of some of the issues I was not expecting have even come up. You mentioned quite rightly on the money supply story, and that's actually very important. Has not been flagged up so much in recent research, but it's true. Behind the money supply story with COVID-19 and the subsequent inflationary pressures that the world is experiencing. I also like the way you introduced the smooth transition model between regimes, because, the war has been ongoing, and maybe the initial shocks were very important, but, the shocks continue, especially the war taking very unpredictable turns. What we are not sure though is whether the markets, the global markets, are able to internalize the ongoing war and therefore reduce the discounting of the war in the evolution of asset prices. Um, somehow you could argue from the market efficiency time of argument that these markets we're all looking at are highly interconnected. So there is the impact you can get from the war, global financial crisis, from COVID-19, but also there is the additional momentum of I think you do actually mention contagion, and that's also an important story in the sense that basically there is initial impact on each market, and then there's of course the contagion across all these markets because of the interrelationships of the markets. So absolutely interesting. We open up for the discussion. I had invited a, a participant to post questions in the chat room, but I don't see any question there. So may I invite you to please raise your hand in the reaction button, and then I will I will invite you to ask your question. Who is going fast? Maybe while colleagues are formulating their question on this, I can start also sharing with you some of my thoughts. I'm just thinking very loud in terms of researchers that look into this issue of the Russian-Ukraine war after when the war stops, when the confrontation stops. And maybe they would be trying to invoke some of the well-known tools like event studies, looking at the macrostructure evolution, the evolution of asset prices. Do you expect that the event studies might uncover something much more different from what what this paper is uncovering at the moment?
So when we did the analysis, we would update it. I think up to the point that we had 3 months either way, because obviously for the global financial and the COVID, we already had the data. But for the war, we were rerunning the analysis as time was going by until we reached that threshold of 3 months either way. So we updated the analysis. I think it was 2 or 3 times, and the results were consistently there. The key results, that is the very fast response, and the more pronounced response of the commodities. So this is what was back then what we thought is very interesting. Of course, back then that would not translate into an inflation, and we thought, okay, maybe we need to give it a bit more time, and it's now actually these days that starts to appear in the news that it is hitting double-digit figures. If we were to give it even more time, the way I see the financial markets is that the response is not there. Financial markets, at least the stock market, are not responding to anything like that. At least not in the way that they did in the first month. So they kind of do not know what to expect, maybe, or they do not know what's going to happen. Nobody does, to be frank. I think only Putin. Would the war stop suddenly? I really doubt it. What perhaps the markets would react when there is a new development that they did not expect. For example, if Russia were to escalate things even more now that has annexed some parts of Ukraine, maybe. Or at some point there was a discussion that Russian forces may enter into Moldova, I think, another country that is adjacent to Ukraine, but is also not part of NATO. If anything like that were to happen, perhaps that classifies as real news. Or if they decide to sit on the table and discuss what's going to happen next.
Yeah, thanks. I think I agree with your observations. It's the other consideration, of course, is the way one looks at inflation, and maybe a the interesting story might lie into the decomposition of the inflation figure, the sense that the devil is in the details, because it may well be that the war shock is very much picked up in terms of the energy prices rather than the energy price inflation rather than a general CPI inflation or GDP deflator type of inflation. And while the COVID-19 induced type of inflation is possibly picked up from is possibly the demand side of it from the money supply. There is quite a lot going on in here. So establishing the cause and effect is what becomes a little bit problematic, I guess. What do you think?
We are not going down the direction of causality here. Of course, the impact of the war on inflation would be we have it in the paper as direction for future research. But what we believe is that inflation is taking pressure from, of course, the rising cost of energy, gas, primarily gas, because it enters everywhere in the production process. But it also hits the household from agricultural commodities because of the very important status of these two countries, particularly Ukraine, in the production of wheat. So on one hand, you have transportation costs, you have heating costs, you have energy production costs going higher, but also there's a component that the raw materials that you are using, like flour, wheat, bread, all of these things, are also increasing.
Okay.
And at the same time, you are coming from an economy that was stimulated because of the COVID response. So there are at least three things going on fueling inflation. And of course, there's the uncertainty because the war still continues.
Thanks very much. I can see some two hands up. Hong and Aisha. I'll start with Hong.
Yes. Hi. I think econometrically, we got the message. So we know that the reaction, the stock market reaction, at least to the war, is not as much as we observed from the COVID-19 event and the financial crisis. But we need to understand what causes the differences in the stock market reaction. And to be able to understand that, we need to understand the differences between or among those events, those shocks, right? So, and so only can we only after we understand those differences can we say something about the policy implications. So, let me see how far I can go in terms of understanding this. First of all, financial crisis was actually initiated from the financial sector, yeah, specifically the mortgage market, the banking sector, liquidity problem, and the COVID, both COVID and the Russian war were initiated basically from the real sector. Let me say, basically, yes, COVID is more from the real sector, but the war is a political event. Let's say it that way. So the question is whether or not do investors react to to different natures of those events differently. That may be something that we can think deeper from the theoretical point of view. Also, from the impact on the real economy, whether or not, for example, COVID affected both the demand side and the supply side. And I would say the coverage of the impact was more than the coverage we observed from the war impact. So the war probably affected the supply side more than the whole real economy. Yeah. So that may account for something, maybe. And in addition to the very big coverage of the COVID impact on the real economy, there is a fear effect. And I heard people do some Google index asking, to measure the fear impact because of COVID. So I think I do not know. I'm not clear about how to explain those differences, the stock market reaction, the differences in stock market reaction to those different events. But I think we can go deeper following those directions to understand which sector that they affect, whether or not the economic or natural disasters affect the stock market differently from political events. So that's probably my initial response. Thank you. But I'm interested in hearing from you.
Thanks, Hong. Yes, Vasileios, Athena, whoever wants to take up this.
Obviously, yes, the events are different. The global financials, the financial, the COVID-19, either an exogenous or a real shock directly. But still, we might expect, at least in the European continent, that the war is largely catastrophic. So why would the response to a war be less pronounced than the financial collapse of an institution in the other side of the ocean, or to the COVID? I mean, would that mean that we are okay with wars, but we are not okay with a pandemic? Um, is a war easier easier to handle than something else? Or would the investors be less afraid of a war? So these are the questions that come to my mind after these results. And what I think is that following the global financial crisis, we didn't have double-digit inflation. Following the COVID-19, we didn't. Now we have, and now there doesn't seem to be any policy measure that would stop this in the next month or so. If we take the European Union as a bloc, I would think that this crisis would really shake its foundations because there are completely different priorities for countries like Germany as opposed to countries like Italy, Greece, or Spain. And there are, of course, very different ways to construct electricity. Germany doesn't have any nuclear power plants. France is like 80% of nuclear. So, of course, there's a very different mix within the European Union, and that is now coming up. So, would investors not anticipate all of these things back in February or March or April, because our data are like the first 3 months? Maybe, because if that war was more like an operation, 1 week or 2 weeks, yeah, perhaps we wouldn't care about this. But the war is going on, and Ukraine is still not producing wheat, and the gas prices are still at record high levels, and you know, gas supplies for the countries might be full, as they're saying in the news. But what's going to happen if the winter is heavier, or what's going to happen in the next year when we would have to restock supplies and there are no Nord Stream pipelines anymore? So all of these things, to me, they look far more important than the global financial crisis and the COVID. And I don't know why the financial markets are not responding perhaps to this.
Thank you, Vasileios. I think we can, and thank you, Hong, for those comments and observations. We take the comment by Aisha. Aisha, please.
Thank you, Vasileios, for your presentation. Actually, my question is very similar to Hong's question, but I will still forward it. So, my question is also on the investor reaction to financial uncertainty in the global financial markets, and whether we would expect a flight to quality, which means flight to safe havens, and flight to capital. What kind of behaviors investor represent during the war, and whether you have the chance to analyze the distinction between flight to quality and flight to capital during these episodes. And in the same scope, what is the role of safe havens and hedges during the war crisis times? And this is related with financial markets. Also, maybe one suggestion, it would be interesting to see the cross-industry and cross-border contagions due to war crisis. So, yeah.
Yeah. Okay. Yeah. Flight to quality. Of course, we don't have bonds. We don't have bonds, any corporate or sovereign bonds here. But from observing the financial press, obviously interest rates are going high. Central banks in the U.S., central bank in the eurozone, and of course the big discussion of the Bank of England response or delayed response that's sent some shivers in the pound. So with the interest rates going higher, obviously there will be some flight to quality. Whether that is entirely driven by the war in Ukraine, I wouldn't think so, because there's still some effects of the COVID, of the huge expansion in credit during COVID. If you see money supply, M1 figures for US, for example, it shoots through the roof. Massive amounts of funds were given to keep the economy going. So obviously this is going to have some impact. You mentioned about contagion. Yeah, contagion. Uh, we can have a discussion on contagion versus spillovers and things like that. Contagion requires that we know of a crisis. If the crisis is still going on, we can't do much. We could narrow it down to the first, let's say, 1 month of operations. Yeah. If there is contagion across countries, that would be interesting. The downside to that would be if the response is very muted, what kind of contagion are we expecting to find? So my argument here is that the response of stock markets, apart from the first few days, is really muted. It might be more interesting to engage commodities in there. So contagion across commodities, or how commodities, the shock in the commodity prices might be affecting stock markets or bond markets, as you said. So that might be interesting to look at.
Thank you. Thank you, Aisha, and thank you, Vasileios, for the discussion. Now I can see Abi Kedir. Abi.
Okay, thank you, Vasileios, and yeah, for the paper. My question is just one, very maybe rudimentary. I feel that the implication of the war and its impact will be felt through three key channels. The commodity price channel, I think, which you have examined. But I feel that there are also important information coming from economic sanctions, and that is the second, maybe a certain, possibly more obvious one that we all know is the supply chain disruption. So did you consider any explicit information coming from these two additional channels in the analysis? Otherwise, I think I like the heterogeneous HR model, AR model, and also the smoothing, the smooth transition HAR for the robustness that you have done. I learned something out of this, and I'm not an expert in this area, but what is your view on the two channels?
Thank you, Abi, for the insightful comments. Very glad that you learned something on the smooth transition. For the three channels on inflation, sanctions, yes. So sanctions, there is a literature, there is a growing literature on the impact of sanctions of, the impact of sanctions, how successful they have been, or the impact of sanctions on financial markets and things like that. We kind of steered away from that because sanctions were always, there was like a list of sanctions. We have it in the paper, but it kept increasing. And to be frank, I don't know how successful they are. I'm genuinely interested in that literature because I want to see how successful they are, because we might be blocking, let's say, imports from Russia, but if we need oil, what are we going to do? Or if we need gas. So as European Union or as UK, we might be imposing sanctions, but if, let's say, India or Pakistan does not have sanctions, and the commodity might be going around. So there is this issue on sanctions, but we haven't addressed that just to maintain some contribution, some novelty. The supply chain is particularly important, and this is also highlighted in the commodities. So the commodities bring up some supply chain issues. For instance, let alone that Ukraine was one of the top 3 exporters of wheat, most of that wheat would come through the Black Sea ports. Now it has to travel through road convoys or trains, which is much more expensive. So any production that, let's say, Ukraine is still able to make up, that also is going to be much more expensive because of the means of transportation. So supply chain disruptions is something that a study could look at more focused on these bits.
Thank you very much.
Thank you.
Thank you, both Abi and Vasileios. I don't know whether Athena, you may have something to add to this discussion. If you wish to,
Yes, Victor. Based on the discussion and the comments that I heard, I have made a couple of notes, and probably I'm thinking out loud now. So, starting from Hong's point, I think the issue here is, so how do we define a crisis? So obviously in this paper we have different kind of crises. So crises that arise from geopolitical risk, from natural disasters, and from the economic system, so like an endogenous crisis. But at the end of the day, how do we define what is crisis and what is not? And another thing that I was thinking about has to do with inflation. So obviously the war happened at a stage where we were already at high inflation levels. And the main reason behind that had to do with the huge money supply that happened as a response to COVID-19. And even for this war, the issue of policy response comes back because there's a difference between short-term response and long-term response. And obviously, at a long term, we want to have a more efficient energy market. So this whole war could be a starting point for a restructuring in the energy market, and obviously one that could be in line with the overall goals of green climate, etc. But at a short-term level, we still have to be mindful of the fact that there could be even more money supply. So there have been talks about supporting households through this increase in energy prices. So I think that the issue comes again in light of this war.
Thank you.
But thank you, and thank you everyone for your contributions.
Yeah, thank you, Athena, once again for those observations and additional comments and clarifications. It appears you would like to come back again.
Can I respond
you're welcome.
So in terms of the monetary policies, we first observe the event, right? And then people reacted. The investors were reacting actually immediately after the event. And then we observe the stock market volatilities, and then came the policies, monetary policies. So that's the order of all types of the development. So if you look at the monetary policy responses to all three events, they used the same thing. So the key point was that they had to put forward some measures which allows them to supply more liquidity to the system, right? So I think I do not know whether we can explain this from the policy point of view, because the responses to all this type of shocks actually was very similar in the past. And I acknowledge that, yes, when the war actually broke out, the inflation was relatively higher, right? Because of the COVID, a lot of quantitative easing, and then it pushed up the interest, the inflation. But I feel that we need more to understand those differences, to understand why stock market reacted differently. But as I said, I do not know. We need to think about them. Thank you.
Thank you.
Thank you very much, Hong, and very important points about the monetary policy reaction in the US, and of course followed by many countries where basically the monetary policy was mainly driven by the hiking of interest rates, something that central banks are still doing up to now, are increasingly becoming a global phenomenon. Yeah. Any maybe I don't know if you would like to respond to Hong's observation, Vasileios.
I think I agree. Yeah, we need more. Obviously, there hasn't been any response. So okay, following the GFC, at least in the US, there was a TARP program that was supposed to recapitalize banks. That was around 700 billion, if I'm not mistaken. Following the COVID, that was dwarfed by what the US announced, which was in the trillions. Following this, there has been nothing like that to such extent, understandably, but all the governments are trying to introduce measures and various support packages for the households to reduce the rising cost of energy. For instance, in the UK here, there is like a reduction on the council tax bill, and there are some other proposed measures. I don't know if we take collectively all of these through some period of time, what would be the budget number? But there are also monetary policies involved following the war, just to alleviate the rising cost of when you go to the supermarket, or the rising cost of electricity, all these things. And I don't know if governments can support the political cost of not doing anything at this front, relatively to what they did in COVID or what they did in the global financial crisis. Because here the crisis really hits the household. Okay? Things that you pay on everyday basis are getting more expensive. And when things start getting more expensive, then your salary may not be enough if your inflation is 10 or 12%. Now that, to me, is linked to rise of extremist movements, either on the right-hand side or the left-hand side. You may have situations that this country has had, back in the 70s, before Margaret Thatcher, with strikes, with union labor. We have strikes, rail strikes for, how many days now? What's going to happen in the next months would depend on the actions the government takes today. And I think that if the household is facing more increased costs, that is a priority for the government, at least for any government, more so than a priority than, on how much the budget would be to recapitalize banks.
Yeah. I think I agree with those observations also, Vasileios, on this issue about a recapitalization of banks. I think any any serious audit of banks in many countries, following the multiple shocks, combinations of COVID-19 and then a combination caused with the war, that it will be inevitable central banks would have to look into possible recapitalization of banks, because actually most of the banks are on the verge of the performance has dropped so much, not only because the projects they had funded before the global financial crisis collapsed, and then they have had problems on their books, on the loan book, but also because the nature of credit from banks has changed since the global financial crisis. So yes, we are into a territory of a combination of kind of shocks. But this paper, in many ways, gives us very interesting insight, and especially by looking not only at the global financial market, but also looking at the commodities trade, which influences what happens in the financial markets and in the real sector. Okay, I don't know whether if you have any last minute comment, observation. Let me look around. Athena, can you see anybody whose hand I may have missed, or in the chat? If I have missed a comment raised, I can't see any of those. So what remains is for us to really thank Vasileios and his co-authors. In fact, I noted that good old friend Guruna is also a co-author in this paper. We thank all the co-authors for this very high quality work, absolutely contemporary, and which pushes us as researchers to think, very carefully in terms of how we can take forward this debate, but also policymakers in terms of there is a shortage of very meaningful, viable policy options. And this has managed to put a couple of, viable, plausible policy options on the table. So that's very much welcome. And so once again, we thank you very much. We want to give a hand of applause to you, Vasileios, Athena, and the co-authors. And also thank you all participants who have been able to come and be in this meeting for 2 hours to brainstorm on some of these issues.